Like we're live. Let me know if you can hear me and see me properly. The title of the live stream today is Gold and Silver Poised to go into phase transition mode as world descends into chaos. And yeah, by the world descending into chaos, I mean what the powers that be are doing in terms of yeah, the situation, political, economic, and financial. And we're gonna have Clive on as usual, but we're also gonna have Francis Hunt, the market sniper, because he's got a really interesting idea about what's going on in terms of the powers that be. I listened to one of his videos recently. I think it was yesterday. He was riding his e-bike or e-scooter. I think it was in Cyprus, and it was really good. Rudy is here. He's under my desk. Unfortunately, Rudy, yesterday I had to take him to the vet. He first thing in the morning, but he's well. He's got a bad infection somewhere sensitive, and yeah, he's been a little bit under the weather, but he's getting a lot better. And he's had to wear this cone around his head. I've taken it off now, but when we go to bed, he has to put that on. He doesn't like that. I wouldn't like to have a cone around my head either. But he'll be back soon. Nice to see loads of you already here. We've got Ho Silver, Endurorama, Dutch Libertarian, Darren Smith, Jake's Custom Parts. Over here, Mario, Bald Guy Money, I believe, released an excellent video this by morning. Worth the time to watch. What's a by morning when it's at home? Ding Dong Daddy 589 is here. Jason G2452 says, "What's up, Mario?" Justin Taylor, Mark Sneed. I might miss a few of you, but not on purpose. Mr. Money 2511 says hello from Richmond, Virginia, the capital of the Confederacy. Barnold 7994 from Edinburgh, Scotland. Cheryl Fetic says hello, Mario. Gifted and Broke says hi, Mario. Kevin, hi, Mario from Ireland. Trump won. Ping only. What's up, Mario? Michael Kennedy. Good evening, Mario. Ridge 891 from Gatineau in Quebec. Indy 5542 says he's been looking forward to this. Benjamin 5007 just left Ron Paul's 50th, 90th, 50th, 90th birthday party. Yeah, he's still going. I met Ron Paul back in 2002 at the Mises Institute. Really nice guy. Peter Borobia from Baja California. Hi, Peter. Rise Above Great Lake from the Great Lakes, Michigan. Robert Do Deus. Some of the names are really tricky for me tonight. What is the true gold silver ratio? Well, it's whatever the market decides it is. Historically, it's been around 10 to 15 to 1. but in the last like 70, 80 years, it's been a lot higher. Can can you house from Edgarsville, Missouri, BC collector or B collector, Rick? I turn liquid gold into solid gold. Oh yeah, I guess it's honey, B collector. Just Ab Esquire says hello, Mary Monaco 64 and Rudy. Greetings from the Scottish borders. Got someone from Finland, Mika Vahavita. Kuinko Tavoite. I think that's how are you in Finnish. Kuinko Tavoite. Susan Cadill from Oregon. Yeah, Matt Gill, 8891 by Antique Hallmarked Silver. Yeah, sterling silver. That's good to buy that if you can get something that you like. I've got a few, let me see if I can get them here. Well, I've got one of them here. This is a sterling sovereign case. So you can put your coins. Let me try to open it. Uh, there we go. This is sterling 925, and you can put your half sovereigns in here and your full sovereigns in here. That's how they used to carry money around back in back in the day, prior to World War One, I would say, Victorian times. And this is made of silver. This costs more than the silver, of course, because it's an antique. News Drifter, Mario, FYI, Bald Guy Money says the Fed just released paper on gold revaluation last week. Yeah, I did a video on that. So, yeah, I'm very aware of that. Let's see, when did I do that video? Uh, let's see. So, where is it? Gold squeeze. Uh, I don't know, but I have spoken about it. Uh, let's see. Was it on my live stream last Sunday? Uh, Maybe, but I have spoken about it. I'm aware of it. It's the Federal Reserve Board. This guy published an article about it. So there you go. Got someone coming, arriving. I'm not sure if it's Clive or Francis. Babers from Dubai. Will the U.S. revalue gold? It's possible. It's possible. You know, the Federal Reserve Board talked about it. There's also the Federal Reserve accounting. There was an accounting thing that came out in May, and now on the 1st of August, there's something from the Federal Reserve Board talking about gold revaluation. Where are they? Oh, don't know why. Here we go. Don't know what happened there. Uh,
Hey guys, how are you?
Hi. How are you?
Great. Thank you. Great. How's everybody
Nice.
doing? How's Clive doing?
Yeah,
How are you
great. I'm doing well, and you?
doing, Mario?
I
Great.
enjoyed that video you made on your was that e-scooter or bike?
Yes. Thank you.
I think Clive is coming on. Waiting for Clive. Uh, FCA Vidya, thank you for your super chat. Love sterling antiques, especially watches. Reminds me of craftsmanship that has been lost in modern times. I was showing Francis and Clive this here. Guess what this is?
Sovereign holder
Yeah, a purse. Yes, sovereign purse.
in silver, is it, or
Yeah,
gold?
sterling silver. No, it's not made of gold. It would have been a bit of a waste, but
I
uh,
remember my father took me around the silver vaults back in the early 70s, and they had lots of little items like that
yeah.
in London. I don't know if you've ever been to the silver
I
vaults,
have a
Mario.
few times. Yeah, I think I bought that one there. And by the way, Gold Investments, they have their vault, private vault at the silver vaults. So pretty safe down there. Yeah, it's a really good place to go if you visit London, the silver vaults. It's near the law courts, isn't it, Clive?
Well, it was,
Yeah.
I can't remember now, but it was a
Yeah.
long, long time. I mean, we're talking 50 years ago, Mario, when I
Yeah.
went.
Yeah. Uh, Just to let you guys know, so the title today, I always pick a title and then we can talk about other things too, is Gold and Silver Poised to go into phase transition mode as world descends into chaos. And the reason I chose that is because I had a look again at this chart. I've been following these two charts very closely. So it's the German mark, the gold mark in paper marks in the 1920s, late after the war, and then the gold price in dollars. The cycle is lasting longer in dollars, but it looks very same to it looks like the same to me. And this is a monthly chart. So if we look at the monthly chart, the spot price here looks like it's breaking out. And I saw that you spoke about, Francis, about the fact that you think this is being done on purpose by the powers that be to basically transfer, well, almost all the wealth from the general public to their pockets. So maybe you could touch upon that, because after I did this, I watched your video and it looks like you're seeing the same thing. You call it hyper stagflation.
Hmm. Yeah. Have we started, Mario? Are you
Yeah,
ready
yeah,
to answer
yeah,
that? Yeah.
yeah.
Okay. Yeah. Yeah. How are you, Clive? Good to see you.
Hello,
Um,
Francis. Very well, thank you, and I hope you're well. It's a hot
yes,
day
indeed.
here in Switzerland.
Yeah, good, good, good. I'm melting in Cyprus. So hyper-stagflation is a phrase we've used literally since just post the subprime crash. And I even secured at one point the global stagflation URL, which I eventually surrendered. I then thought to buy back the hyper stagflation. Then I said, no, we're the market sniper, we're technical, we're method. That's what we do. But I wanted to talk a lot about reset. I had these two babies I was trying to birth simultaneously. One was the fact that we're going into a financial reset, and the other one was technical analysis, how you can see the news before the news. In the end, I went with the HVF method in our community. But the stagflation and hyper-stagflation is a phrase we cobbled together because of associated thinking. A lot of people think, oh, well, it's like the 70s. We tend to, when your mind is being asked, an opinion on something, we use mental association. And association is we bond onto something that we recognize. It's the abyss of something that we haven't experienced before that scares people. So they go, oh, you mean like the 70s? Quickly give them a handle to hold on to. And actually, it's got aspects of the 70s, but it's far more extreme. And that's why we bolted the hyper word to differentiate it from that tendency. You've got to be comfortable in the abyss of trying to associate it. The US is significantly more indebted. Gold has lagged its mark to market far more. And I want to talk about the difference between being revalued to market versus decreed at a whole different level price, which is a totally different bag of eggs to contemplate, because obviously that would probably, especially if you're doing 4 times or 5 times, it would blow up the derivative markets without prior arrangement, especially when we consider the short position on silver and the associated reaction silver would have, etc. But anyway, so the stagflation and the hyper-stagflation is we're going to be actually getting an extreme version. I actually think in real terms, growth will be consistently negative. So it's going to really stagnate. The 70s, you were borderline recession, a little bit above. I think we're going to be consistently, if you got a true inflation rate, contracting over a sustained period. And that is the super stagnation part. And then the inflation part is that they are going out of their way to mask true inflation with a coercive and broad agenda of masking the true level of inflation. Now, many of us know about shrinkflation, reducing packaging sizes, a ton of other tricks that are run, the BLS stats, adjusting the baskets, removing or reducing the effect of things that have been recently very explosive in inflation. There was an element of coffee. It wasn't removed entirely, but there was an element of adjustment after we had a huge move in the coffee beans, Arabica, and all of this. So our whole prognosis is they're actually going to create a resources bull, because that is super inflationary. Because it gets right to the commoditized daily products, which is the last thing to move when you're in an inflation cycle. So we're in the commodities. Commoditization actually means, by definition, that there's no supernormal profits. It's not just meaning futures and grains, and it has a dual meaning. People tend to rephrase it, the commodities, live hogs, that all of that. But in actual fact, when things get commoditized, it's no supernormal profits, and only very efficient scale producers actually make what is typically referred in economic terms as normal returns. And that's not spectacular. You have to have a massive farm, you have to have all the right equipment, you have to run it on way less people, all the technological advances which are disinflationary. You have to have all those benefits and keep being better as a farmer just to make the same grind. Let's call it 100 grand a year or whatever it is that sustains a farmer if he's to be profitable. And ever greater farmers, ever more capital equipment, so you end up with a big balance sheet. So commoditization is the last thing that actually has price buoyancy, because everything else has moved before, and we've already seen that in asset prices. Go ahead.
Yeah, no, I just wanted to add as well that you said in your video on your bike that they're going to use AI is going to be hugely deflationary as well, or disinflationary.
Correct.
So they need to hyperinflate.
Explode the inflation
to make that, because the debt
100%.
is there. So that was really interesting.
So
And
I actually mentioned on average you can be at a good temperature by standing in a bucket of red hot coals and in water, and you can still be 36.4 degrees, and your foot is melting on the one side and is in a block of ice in the other side. So we've actually got this sort of global dimming and this global warming vibe where the one is cancelling each other out. And AI is going to reduce employment on most menial tasks and many less menial tasks, going to be highly negative for employment. That's the stag, which is going to be hyper-stagflation. So you're going to get a chronic degree of unemployment, and in that participation rates continue going to drop. I'm mainly using America as the model here because it's such an important economy and it's the hegemon and all of that when I'm doing this, but it will actually be Western and broader. So you're going to get that huge disinflationary, but the problem is you're going to have all these people that aren't earning anymore, and that's going to be dropping to breadline. State is over indebted, so welfare is going to be actually in real terms dropping off unless they're jacking it up immensely, which they don't have the money to do. So the key thing is they want to debase their debt and their currency chronically to keep the obscene levels of debt manageable, so they continue to breathe. So we've really just got this much air between us and the ice, and they're going right up to try and breathe with this debt level that keeps coming to drown him. And as a result, they need chronic actual inflation. Now, when you allow resources the base level resources, the things we are eating every day on our table, milk, eggs, everything, to become runaway. And we've already seen a little bit of a sign of this with the Japanese and a doubling in the rice. I mentioned incorrectly on my video, and I want to recorrect it. I did in a subsequent one, but depending which one you saw, a lady did a Walmart checkout list. It was actually 2020 to this year, and I said it was 1 year. I should have sanity tested that, but it was 135%. So she did a checkout basket of the same slip that she'd kept from 2020, and it was Walmart, and it was 135% higher 5 years later.
The other thing, sorry, just interrupt on that inflation thing, is that you talked about shrinkflation. The other thing they do now, like if you notice, you go to restaurants, the restaurants, if you want a side, you have to pay for the side now. In the past, everything was included. When you book flights as well, now you have to pay to reserve your seat. And I wonder if these big corporations and companies are told by accountants to do that, and the accountants are told by the government, so that, you know, a main meal used to cost £15, but now it costs like 25 if you add all the sides. So yeah, they're gonna keep cheating us. Just wanted to move to Clive a little bit because MP Platt Senior, Platts Jr., thank you for your super chat. He says, good evening, Mario. If Clive is correct and gold is revalued to 15,000, what happens to the U.S. bill, note, and bond markets over the next couple of years? So I'll let Clive answer first, and then Francis can answer that too.
Well, first of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates, which is not part of the USA debt, doesn't have any interest, and has no maturity date. So what they're basically doing, if they do a revaluation at any level, they are swapping the debt that they have at the moment, or some of it, for gold certificates, which is not debt according to the official the Treasury balance sheet. Now, as I said, the higher the price they do it, the better it is. So I picked a figure out of the air of 15,000. I kind of felt my figure was on the low level compared with some other people who've been picking 20,000. But of course, the level at which they'll do it, if they do it at all, would be at what level do they dare to do it without disrupting the market? Because we don't want to, well, they don't want to do a figure which is going to make people panic and say, oh my God, the dollar's worthless because they've done this. So I kind of chose that number based on what I thought would be a right number relative to the amount of money they've been printing in the past. As you know, they're printing roughly $2 trillion a year effectively in new debt to pay for the budget deficit. So the figure I picked of $15,000 would cause a new printing of 3.9 trillion as opposed to the 2 trillion a year which is being created. So that would be very, very slightly inflationary, not much. I mean, let's face it, with the amount of money which has been coming into existence over the years, it's not a big deal. For example, it's only about 10% of the national debt. So it's not a really big deal. So I'm looking at the question. He said, if Clive is correct and gold is revalued to 15,000, what happens to the US bill, note, and bond markets over the next couple of years? Well, first of all, what happens to the bond markets? I think the immediate reaction is it's positive for bonds, because if they do this, they don't need to step into the market borrowing quite as much money as they needed to. Therefore, the natural buyers of bonds, who would be naturally in there buying the bonds, won't have those new bonds being issued. They won't be available for a very short period. So that should be positive for the bond markets. It won't affect the T-bill market at all. And I don't think retail prices are going to be affected in the slightest, because retail prices are not linked to the gold price. Francis, what do you think of all that?
Yes, so I want to, in terms of this reval discussion, I've got a couple of quick fire thoughts that I thought everyone should do. There's a massive difference between mark to marking. We've had 54 years without marking to market. We're at $42.22. And that's actually would have very close to zero, although minor bullish, because it's going to drag gold into the spotlight again. And it's my overall assessment that that central bankers love to ignore gold. And the last thing they want is retail and media overly focusing on gold, because gold is the canary in the proverbial gold mine, if we can. And in the 54 years, the dollar debasement, which means actually the gold appreciation, these things are totally synonymous when I use the dollar debasement and gold, because gold is the benchmark that we assess its debasement by, has actually seen the dollar lose in those 54 years on average compounded 8.4%. And I will tell you that in the last five, since COVID particularly, in actual fact, disproportionate of that 8.4% would be happening now. So an average is again misleading, a la my ice bucket and fire bucket analogy. You're actually getting the acceleration parabola now in terms of loss of valuation. And that's come on the splurge of debt with our 2020 crash call on the bond market. And with the bond market crashing, you've got to treat the dollar and the treasuries or T-bills, the short or the long-term variety, as almost synonymous. You get step debasement of both. So an acknowledgement that if you do a mark to market, that means you accept the current price discovery mechanism and you move the gold price to there. There is no derivative immediate effect, I would say. Anything that involves a multiple, and Clive's example to 15, and he was the most conservative in fairness to Clive. George was at 20 and others were at 20. So he wasn't going all, Max Kaiser 1 million Bitcoin out of everybody else. I do think it's a clickbaity title, because there's a bit of hopium that it instills in precious metals people that I don't think will truly transpire. Because if you did a gap of 4.5 times the gold price to 20,000, let's take on the other guys apart from Clive, who was the most conservative in that, but you're still, even at 15, talking a big multiple. You're instantly blowing up, I'd imagine, a lot of derivatives straight off the cuff to organize something like that didn't destroy the banking system. So then if I say that, some people will say, well, maybe they're planning to destroy the banking system because everything's now going to be, a digital system and go just to central banks. I then remind everybody that those banks that have those derivatives were probably doing that serving the central banks and are the primary shareholders of said central banks. So it's a bit like the dog voting to have his own tail cut off, or vice versa. If you treat the central banks as the tail, it's a bit like the dog voting for his tail to be cut off. And the head represents actually the bank. It's part of the same mechanism. So to pass a huge loss, then there's the other thing, it would be a temporary measure. They're going to come back and do it. They would have to do it again. And by the way, Richard Nixon actually had 2 increases. I was having this
I just want to. Sorry to interrupt you.
Go ahead, jump in whenever you like.
I've got them in 1972 they revalued from $35, which had been the price since 1934, to 38. So it was around here, and it never.
And then a year later to 42.22.
Yeah, and it never went back below 38 again. And then they did it to 40. They were always behind the curve. They did it to 42.22 here, and gold just kept going up. So I personally think, the other thing I wanted to say is that I don't care if they do revaluation. Yeah, of course, it would be like a cherry on the sundae, on top of the sundae, would be really nice for gold bugs. But the reason why we hold gold is not for revaluation, is because it's a protection against debasement. But I think if they revalued to the market, like 3,400, where we're now roughly, we would see gold go to 5,000, 6,000 in the next year, just like it moved here in the 70s.
More likely
And
modern.
yeah,
Yeah.
and that 3,400 or 500, whatever, that would be never seen again. We'll never trade there.
It's
30,
establishment of a floor,
yeah,
basically.
yeah, and 3,500 would be a good number because it would be, 100 times the 35 level that you had pre Richard Nixon.
Can I make a point on that as well? And then you can hand over to Clive if you choose. That was by very small increment. Not super small, it's still a percent, but it's not a 5x or a 4x. And the level of derivative overhang in manipulation was largely not what it is today, is my assertion. In other words, there was less likely to have repercussions. So again, I'm differentiating 70s to today. I'm saying I think we have something that resembles that. And it's going to be a contained bull run, and they're going to need ever more access to ability to borrow. So they're going to dip into that newfound, call it an overdraft, but it's quickly, once it's used, it's used. Then they're going to need it again. But to do the hyper over the decree, would also require government to actually buy at that level to be meaningful as a price. Otherwise, we ignore it. I mean, I can stand up and say gold should be 100,000. It's not going to trade 100,000 tomorrow. If you have a big institution like a government, a Fed that actually engages in the market and says almost on a bottomless basis, we will give you treasuries to the value or dollars to the value at 20,000, then you have a buyer and now you have volume. And because of arbitrage, all the other exchanges would fall in line, providing that it tested and met the criteria that they're going to keep
It's
doubling 20.
almost like a yield curve control, isn't it? But for a gold price control, the Fed would have to do.
They would have to do that, and they'd have to have an open window at all times.
Yeah.
And you would be stupid to actually use it, but it would certainly warrant testing by other people to a high degree to show that they're prepared to back it. But why not, wouldn't they? Because if they know that their fiat is being debased, it's a good trade for them, maybe even at that level. But the problem comes with the banks. You would get an inflation surge. Now, going back to my scooter video, they actually want that. They want bread up. And Trump is playing a game, a disingenuous game for me. He's being told Powell's the enemy, he's not doing cuts. There's other YouTube commentators that saying the Fed doesn't get it, they need to cut, there's so many signals. The point of the matter is there's no appetite for the debt instruments at a higher price with a lower yield. So they can't get debt out. It's a bit like saying, I'm charging you my pink Crocs example with all the queue of container ships. And now instead of selling them for $10, I say you should pay 50 and they're not going to last as long. People don't want to buy more expensive bonds on a lower yield. They want it to go the other way. We haven't had that correction. Rates are going to be generally higher in spite of, and that's the stag part, people are going to suffer with their housing, their debt, particularly America, but Western world and the highly indebted nations where the consumer is highly indebted, that's where they're going to stagnate because their borrowing costs, their cost of living are going to go up, your bread and milk's going to go up, and they're going to hide. They've introduced an aspect of estimation since tariffs on part of the CPI calculation, and that is calculated understating. It's very much like the non-farm payroll numbers. Non-farm payroll numbers is a fraud. They revise monthly and then they come back and do an annual revision. I mentioned also the unemployment is a non-true stat if you don't take participation rate into account. They made it sound like unemployment's only marginally gone up, but the participation rate has plunged 0.5% on the last non-farm payrolls. And then inflation. I'm looking actually to get John Williams on, and I mean, you use one basis of comparison and you stick to it. Of goods. It might need some adjusting because of styles. You didn't have iPhones in the 80s, but it shouldn't shift that much. And they've, of course, muddied the water where the basis of comparison is being moved all the time, that there's no true understanding of the inflation. And I think we're going to face in the teens, deep in the teens. So if you aren't getting a return, I would say at minimum 15 plus, a good, decent return, sounds like a lot, 25, but if 15% is your actual inflation rate, you're probably barely going forward by about 10% per annum. But you're going to have a boomer resource, boomer commodity environment. They are effectively, while talking anti-inflation and must cut the rates and a poor consumer for political optics, they are in actual fact going about increasing inflation in everything we do, and tariffs is part of that and is inflationary on the American consumer. So don't listen to what they say, look at what they do, hence our hyper-stagflation phrase. They are pushing inflation. They need the debasement of both the dollar and the debt markets, because obviously when you're reducing the dollar, it's also the measure of the debt valuation. So this is super mega financial repression era. And let me hand back to you.
Clive, so before you chime in again on the revaluation, I'm sure you might want to say something again. Just want to ask quickly a yes or no for Francis in terms of the derivatives in the banking system. If they revalued gold, and can't they just cancel the derivatives contracts and say, so that they can do the 15 or 20,000 and tell the banks, don't worry, we'll just cancel those trades, just like the LME canceled the nickel trades?
Well, you've got to remember that this is a rolling position that could have been run for a very long time, and there's counterparties to that. So what's bad for one could be exceedingly good for the other. And if you cancel something, the people that it's good for that are on the other side of that might have quite a big complaint, and there's legals and all sorts of things that could break out with that. If they just did some sort, you're referring to some form of force majeure event where you almost go, all legalese doesn't count, and we just clear this whole deck. The problem is if they've been selling short all that supply, miners have actually locked in prices that are actually providers of that. So that would then mean there would be no sales of the silver, and it could have to go even higher. So in some senses, it could be a major accelerant, because actually most of the forward selling miners have done has not been beneficial, especially given the current mining market conditions.
Yeah, it might be good for the miners. It would be great for the miners then.
It should be, because that forward sold too much at lower prices. That's my take.
Okay, Clive, just before you chime in, Clive, just want to thank Jiz Motriner for the super chat. And I think it's a she. She's asking, do you reckon you'll ever actually get to spend your gold and silver, or does the more you learn just make you less inclined to use it? So I'll let you answer that, Clive, and also add on to the revaluation.
Well, I think if you're buying physical gold and silver in the form of coins and bars, the thought process ought to be one of, I'll keep it forever unless there's no choice. So it's kind of like an heirloom. It's a bit like if you buy a painting, you put it on your wall and you expect to pass it down the generations. Obviously, it's an asset which can fly a little bit under the radar screen, which can be advantageous depending on how you look at it as well. So when I buy physical metals, I tend to think that I'm not buying them with a plan to sell tomorrow or next week or next year or 5 years or 10 years or at any price. It's kind of like the parachute you've got just in case the worst comes to the worst and you've got no choice. But if you want to trade in and out of gold and silver, then the way to do it is the way, I know you don't like it, Mario, but the way to do it is through ETFs or gold mining shares or things on the stock market where you can trade with a very narrow spread and at high speed. But that's a completely different kettle of fish from having a parachute. Trading is where you buy something with a plan to sell it quickly and make a profit. Whereas I think the reason why a lot of people are choosing to buy gold these days is because they fear that the financial system that we are in is getting close to the end. I fear the trust in fiat money could evaporate very quickly, and then they might be forced into a new system. And if you own a gold coin before we cross that line, you'll still own it afterwards. Whereas if you've got something in custody, subject to the whims of a third party, you're not sure where you're going to stand. You're not sure if they're going to take it from you.
Clive's Cosmic Seeker 69 says, some of us don't have any family. I guess if you do have gold and you don't have any family, the older you get, I suggest you take advantage of it and enjoy life because you can't. I guess you could take it with you. You could be buried with it, but what's the point?
Ah, well, I would have thought that if you've got little bit of gold or a lot of gold, they'll be lining up to marry you.
That's well, yeah, that's a different topic. Yeah.
Just coming back a little bit to Francis, you said an awful lot of things that I was wanting to interject left, right, and centre. To tell the truth, I do agree with everything you said. But maybe I'll just make a couple of little comments here. First of all, the force majeure on the exchanges, as you said, Francis, if they cancel contracts, there's going to be winners and losers. The exchanges do have the ability to do things like that in force majeure situations. It's not even a question of changing the rules. They could just do it, as was demonstrated when they used the existing rules against the Hunt brothers many decades ago, because they thought they had too much silver and the shorts were getting squeezed and couldn't pay the bill. So it's not beyond the bounds of possibility that they might use a force majeure clause and say, okay, something funny's happened. We're now going to do whatever we have to do. I mean, we could go back to other examples of that in history. Go back not in commodities, but in the 1900s when we had this massive railway stock which went to the moon when everybody was short of it. J.P. Morgan, the man, not the company, steps in and gets a subpoena from a judge which says people don't have to deliver the shares. The people who bought the shares are not allowed to demand them, but everything has to be settled at $150 instead of the $1,000 per share price, because the share had basically done 10x. These sort of things can happen where they set a middle of the road price where settlement would occur. So that's on the force majeure. On the question of
a lot of
what
that's on
happens.
single events as well. What you've got to bear in mind is this could be multi-years, even spanning decades of accumulation and rolling contracts. So the scale would be vast,
Yep.
and it would have the negative effect. And as I say, legally anything can be stopped, and you can do a court case. But you also have confidence in markets that gets hurt every time these things happen, and a very big one would be very damaging, which this would invariably be. But things would heal eventually. Again, I suppose that's just a point worth making. This is not small surgery we're talking here.
Now, let's just move to the mark-to-market question. What happens if the Treasury marks gold up to the market price? Well, as Mario said, that puts a floor, or maybe you said it, Francois, I think you both said it, that puts a floor under the gold price, assuming that the Treasury is standing ready to buy gold from all comers at that price. I would have thought, for two reasons, that it's better that the price is higher rather than the market price. The first reason is this: if they put a higher price than the market price, it would presumably suck in gold, because there'll be people taking advantage, immediate advantage, in the first few days anyway. They'll say, "Oh, I'll sell my gold and take advantage of this higher gold price while it lasts." Now, from the Treasury's perspective, that's not a bad thing, because they're getting a much larger gold stash, which will allow them to call the shots even better if we ever have to go back to a gold standard or whatever might happen in the future. And of course, with a larger stash, they can do the revaluation of gold over and over again. That you touched on that, Francis. But coming back year after year to do revaluation, the more you've got, the greater the profit when you revalue upwards. So the second point about is higher than if it's higher than the current price, the higher it is, the more profit they make, the more money they get to print, and the more money they get to print, the more they can reduce the debt or cover the current year's deficit. So it's only a question of quantum. How far do they dare to go? If the gold price is 3,300, do they only dare to go as far as 3,500? Would they dare for 4,000? And if 4,000, why not 5,000? If 5,000, why not 10? And so on. So obviously you get to a point where it becomes ridiculous.
There's a lot more to discuss. If I can come back on some of these points.
Yeah. Can I just, sorry.
A whole bunch wealthier every time we do this. We have to bear in mind that this is, if we're just talking about America, the Fed and Bessents doing this, your biggest enemies will be gaining.
Yeah, I
as
agree.
well with all of
China and the Russians, they have, I mean, Russia has a, no, not Russia, but China. Some people think they've got over 30,000 tons and not 2,300.
well
Before,
beyond that. Yeah.
yeah, yeah. Just
Well,
want a super chat here. Chris Conman, thank you for your super chat. And he asks, as far as possible gold, silver confiscation is concerned, do you think the US government would extract them via stable coins, use banks as a conduit for such an act? Thanks. I'll answer that first, and then Francis, and then Clive. I interviewed an Italian guy a few weeks ago. His name was Andrea Cecchi, and he thinks that the confiscation will be done via allowing the gold price to like skyrocket. He used 20, I think he used 20,000 or even 40,000, I don't know, as a revaluation. And he said that will play into people's greed and they will sell their gold for fiat, which is worthless. And then the government will get, and the bankers will get all the gold. So that's the way I actually agree with Andrea Cecchi. Or they could also take it from the GLD. The ETFs have a lot of gold, and it's a lot easier to take it from the GLD than go around every American that has gold. And I don't think many Americans have gold in terms of a percentage of the population. So, Francis, what do you think?
what does history show us on revaluation conduct? It shows us that government has no interest in making its citizens wealthy. What did they do previously? Roosevelt got everyone out of the metals by decree, by threat of law, massive fines that would run into millions today. It was tens of thousands back then when you bought houses for that kind of money, and multiple years in jail. What did the events of COVID tell you about their approach? They're in it to enrich themselves. You weren't given the heads up of something coming, then everyone's speculating and all jumping into farmer shares. They took the money and they closed your businesses down. What do the possibilities of the great taking tell you? The possibilities of the legalese versus the English show that there's quite possibly, and I give it great plaudit, an intention. And when you understand where they're seeking to take us, and this is my conspiratorial nature, Clive might think, but we are looking at a global communism and totalitarianism to make everybody reliant on UBI, as large a segment of the population as possible, so that you ultimately control them. If you control the food supply and you control how they earn and what they can eat, you have the end goal that I believe these people have always sought. So the lottery hope of a 4x, 5x, 6x on gold that will benefit quite a reasonable sway. Now, as we say, hedge funds don't really have a lot of gold, but there is still in the liberty movement quite a high tendency to stack gold and silver, that their greatest enemies, and believe you me, libertarian people who seek self-reliance are invariably the biggest enemies of a totalitarian state who's seeking a great leveling in the Western markets. You are not likely to get this lottery ticket. And I don't want to be the guy behind hopium on this for a number of reasons. However, truth does out, and I think the option of a mark to market isn't far more likely. And the force of necessity and the inflation that they're going to be generating could see Nixon-esque regular mark-to-markets to open up the overdraft out of force of necessity, which probably means they'll go either for a similar confiscation or other aspect, which is a bit draconian, but depends how totalitarian we get. We're being told a lot what to do. But they can also do their unrealized capital gains, which is what probably my primary scenario, where they can enforce sales by instituting an unrealized capital gain on you. So they want to know what you have, so you're going to have to blockchain it. I would suggest maybe having some gray or black gold, which would be off-grid, illegal, and probably punishable by death, given that they're the Marxists that they are. And you probably will face capital gains tax, even if you have not sold, just by virtue as they know we're patient stackers. That's how they have a plan for gold and silver, guys. Without a doubt. And they aren't going to enrich us without a clawback or an attack vector. And it's not good news for me to say that. Don't shoot the messenger. I'm just very clear about what history tells us about the kind of people we're dealing with. They do the revals after they've stripped you out. And if they're not going to be able to get away with doing that now, they're going to make sure they get their pound of flesh out of you, the Shylocks that they are. So that's my take for the question. We've got to watch for those attack vectors. If they do end up giving you a decreed new price that isn't price discovery, there's a lot of legalese that will have to be negotiated. I don't believe they'll be prepared to bankrupt the banks, their shareholders. And I don't think it's a high probability, and don't get sold on hope, because then you don't get the crash of the disappointment. Mark to market is far more feasible. And I think it could regularly be mark to market, because once they do it once, it becomes the tap that they keep dribbling the drops out of and getting sustenance. So it could be repeat. And I think you should keep doubling down and keep giving them back their fiat and keep stacking. And you should have locality optionality so that you don't get taxed out of your metals. And that's what we do for our community very specifically, because it's not just what you make, it's what you get to keep.
Clive, what do you think about the question there? It's about confiscation.
First of all, I believe the motive for confiscating people's gold is rather about government not having enough money to pay its bills, and they're not paying the bills in gold, at least not today. Now, this might happen in the future, but so I don't think confiscation is a big probability. I think it's obviously we can't say never, never, but I don't think it's very high. On the question of taxation of gains, well, we're in a global market melt-up as we speak for the last 5 years, effectively, and that is where the inflation is going. The inflation is not really going into the retail prices, the consumer prices. We see them plodding along at, apparently, if you believe the numbers, 3% a year. But the real inflation is in the things which are in short supply and wanted, and that includes stocks, and of course it includes gold and silver. So we've got various capital gains taxes in some countries on realized gains. I think it'd be craziness to have taxes on unrealized gains, but we can't exclude that. It is a possibility, but it would be a really dangerous precedent, because it would be a huge disincentive for anybody to invest in anything. And governments do need, at least in a capitalist society, if they want to maintain that, they do need risk takers who are willing to risk money. But if you risk money and find you pay a tax on your unrealized gain, and then next year the company you invested in goes bust, that's obviously going to be dissuasive for people who are potential investors. So I hope that the capital gains tax on unrealized gains does not come. I think it'd be foolhardy. What else could I say? The conspiracy. I think a lot of what Francis has said will come true, but I'm not of the opinion that it's a conspiracy. I think it's just a direction of travel, and a normal direction of travel borne out by the way history's played out in the past, and I think it's going to play out very similarly in the future. So yes, we will probably end up in a fairly dystopian type of society, but is it a conspiracy by the powers that be? I can't see that. I just think it's the direction of travel that we're in. Everybody looking after their own backs, and the people who look after their backs most are the ones who are in power. And the way they look after their backs the best is to ensure that all the wealth flows to their hands by whatever means possible. But I mean, I think the big question here, everybody who's listening wants to know, and I'm going to open it up to Francis, how do we protect ourselves? What would you say, Francis, is the best way for an individual who's got too much wealth, or some wealth, let's say, to protect himself against what's coming?
Well, that's what our business is based around. And unfortunately, for most of the people listening, they're not going to like the answer. The problem is the people who are listening, 95% of them have the same passport as the same country that they were born in, that they work in, that their company is in, and bank in that same country, and everything else. And when you are a captured citizen of birth, passport, and every other aspect, and I know, Clive, you actually are not, and I applaud that. And I know Mario is working on his structure, so this is not directed at anybody per se, but my assumption about the audience, which may even be wrong, you will fall foul of governmental rules. The UK, and we'll have a reasonable American and UK audience right now because of Mario being UK based, is in absolutely scavenge mode. I mean, they're in the business of they're mining black holes in their budget. That's how bad it is. They keep finding black holes. If black holes was a product worth selling, they'd have made
Yeah.
billions. And the only way is to punish their indigenous population repeatedly. And as long as they remain there, so the beatings will continue until morale improves, which of course it won't, and neither will the financials, which will open up further black holes because you're now going to chase anybody who had any aspiration of any kind out of your country. And this is where we do differ. I actually think that they are meant to be directed to Dubai and the UAE, and I would strongly suggest you don't go there. But initially, if you did, you would be more secure, although you'll swelter and you'll be living in an aircon environment, and you will have temporary lower taxes. But that, to me, is a Judas goat of a trap, actually. And I think there's other places in the world that you should explore before ending up in the Middle East. But that's a personal opinion based on my study of history and the various other topics that are a bit too esoteric for this discussion. So the UK is in scavenge mode, and we will have a lot of UK people watching right now. And I travel on a UK passport, and I have great empathy. And despite its crappy weather, a lot of the time it's a country I still have a lot of gratitude and alignment towards. And I just think everybody there should be planning to leave, but not to where they are trying to send you. And it's just not a happy message. So I think they will get away with all sorts of possible taxes. And I think we are being continually tested with fear. We're getting von der Leyen and Lagarde, Starmer, and all of these people actually making outrageous statements that 15 years ago, if I told you someone would stand up and say that to the localized population and carry on a two-tier policing system, nobody would say, we wouldn't stand for it. We would be raging in the streets. And I'm going, and how did that work out? Did you see CV19? Did you see anything? They got away with doing outrageous things. I think Clive needs to stretch his brain on imagination and have a look at what they've got away with doing to us. They arrested people having Christmas Day because there was one too many people in a Christmas dinner and dragged people out. They had grannies off benches. It's an outrage, overreach of government, and they are now bankrupt, and you now face, and you've never faced this before. Let's be clear, most people are younger than me watching this. We had a 40-year bull market in bonds that ended in 2020. They do not have the funding mechanism anymore that they once had, pushing a demographics pensions into this asset class. That asset class is failing. It's going to be financial repression. Its capital growth is going to be negative, and its rate of return is going to be insufficient for the true inflation rate. That means nobody wants that asset anymore. That means you're going to face higher rates and consistent. It's going to be far worse than the 70s. And Britain could be the poor man of Europe, and they will be stealing every little red penny they can get out of you from everything in your face. Ridiculous taxation. Because once you start down that road, just to keep breathing, you have to keep doing the thing that's killing you. It's the same as how we got into this debt-based problem. We borrowed more so that we could get through a contagion. You continue to do it until there's no more wiggle room. And that's the position the government finds it in. It might not be by diktat and plan, as Clive says. It's the only way you end up, however, because of the measures once you've chosen to be anti-competitive and unfriendly to your biggest value creators, you only get to double down. You only get to dig when you're in that hole. You don't get any other options. So dig they do. So I think everybody needs far more optionality on where they pay capital gains. And we have a number of options that are listed as capital gains zero and would entrench those for you and protect your wealth, while your buddies who stayed behind could be facing 50, 60 once-off taxes. Don't forget, we've had a flat energy price tax on oil companies before. Just let it for a year.
Sorry to interrupt you, Francis. I actually had this article here to show the viewers and you guys, because they're thinking of now accessing. Well, they are going to do this from April 2027. The taxman will be able to access your savings accounts, your bank accounts, to see if you're earning interest, and they're going to tax you directly. The other thing I would say about capital gains, there are, and I'm not like saying that I don't agree with Francis. Yeah, it's good to have optionality. My father, we grew up in Brazil, and when things were getting really bad, he got his Italian passport because his granddad was Italian, and we all got it. And that's one of the ways I was able to go and live in Switzerland and come live here. So I'm aware of that. But there are ways here in the UK still to protect yourself. I know it's getting harder and harder, but in terms of capital gains here, gold and silver, if you buy coins of the realm, there is no capital gains tax. The other thing that I've been doing, Francis, is because I invest in the gold and silver miners, and for the last 3 years, I've been putting as much as I can in the tax-free ISAs, and it actually adds up, and they might change that, but they can't go back and change it. So there are ways about it. And the other thing that not everyone can do in the UK, if you are like self-employed and your business is improving, you should think about creating a limited company and becoming the employee of that company and paying yourself the least amount of wages or salary as possible. And then there are ways to pay yourself dividends. I'm not an accountant but and tax advisor, but I think there are ways about it. And one downside, Francis, about having optionality. You never really know when you go to another country what's going to happen there too. Like I saw that Italy, they welcomed a few years ago billionaires, I think more like it, or very wealthy people, and they said you're only going to pay maximum 100,000 euros tax a year. So for someone who pays millions a year, that was good. But now they've changed it to 200,000. So I think you've got to be careful, but I agree with you. You need to have
Do you
options.
want 10 options or do you want one? So
Yeah,
yes, some
more
of them
than
are
one is
shaky
good.
or
Yeah, yeah,
unreliable or change and flex.
yeah,
That's my
yeah,
question.
yeah. Clive, anything
Well,
to add to that?
I'm gobsmacked, Mario, Francis, because listen to you, Francis. I think I need to buy a long piece of rope because it sounds like we've got no hope.
We don't have no hope. We have plenty of hope, but we've got to plan for the worst. The smart people plan for the worst and extend their imagination to see the fullness of how bad the books are for nation states and what
Yeah, no,
comes
you're
out
right.
of that
You're right.
and
You're
how
right.
many options they have and the trajectory they've already chosen to take.
Yeah.
It's
But
extrapolation. It's not.
Don't you think, though, that one of the things that I think helps a little bit is to try to keep as much as your wealth as possible outside the financial system because they don't, if you keep it outside,
Well,
it's
it sounds like you're
harder.
talking about an asset offshore, Mario, and that's
Not
exactly.
not not offshore, but also something physical, even where you live. You can like it's
And
called.
off
Could you
grid
be
when they
talking about,
ask you
Mario?
to
Something
register
physical?
it.
I'm getting close. What are we talking about? Something physical you could hide away and nobody
Gold,
knows you've
yeah,
got
gold
it?
and silver, yeah. But there's
Oh,
also
yes, of course. I never thought of
well, there's
that.
also something like antiques, chattel. There's no, I don't think any capital gains tax on things like watches, and there are ways.
So
So I
watch that if
think,
you're not an expert in it, Mario. If you aren't already an old fine wine and Persian
yeah, yeah,
rugs and all of this, people lose their shirts and get mugged by unscrupulous. Gold and silver is the best place. We don't
yeah,
need it.
yeah,
This is not the variable. The variable is not gold and silver. Gold and silver is locked
uh,
in for me, for
yeah,
most people, over everything else, vintage cars and fancy stuff. If you're not
yeah.
a fundi, you're gonna be mugged.
But
I've
I
heard plenty
agree
of
with.
people.
I would say to Francis that if I was 25 years younger, yeah, I would look to move. But I'm 60 now, and
You can live anywhere. You can do a lot
yeah,
of things. You can still visit the UK. There's a
yeah,
certain amount of days. Jurisdiction and
yeah.
legal structures are paramount, and
Mm,
that's what we actually should be talking about. And that's what they, and you can decide who they is, use that they don't fall foul of their own tax extracting ruses. So, you know, you need to listen less to what they say and how you should pay your new tax and it's equitable and fair, and more at
Oh
what they
yeah,
do.
don't
And
worry, I
we'll
don't
tell you
listen.
what they do
I
because
don't
we're
listen
doing
to
it.
them at all.
Yeah.
I do the least listening as possible. Um, let's see if we've got
What
some.
do you guys, I mean, let's bring it back to gold and silver. Are we, they did this funny announcement that they've
Oh
now
yeah,
repented.
it
Um,
looks like they're gonna backtrack on it,
yes,
Francis. And I noticed on Friday most of the activity was in the COMEX.
featured. Yeah,
Yeah, the
COMEX featured.
spot price in London or world price didn't do much. It closed just below 3,400. So I think someone in the customs had no clue and told the lawyer for the Swiss companies, "Oh yeah, we're gonna put tariffs on that." But I think it was a mistake,
I
and
think it was an accidentally on purpose mistake as a semi drill to see what the markets would do and a
could
little
be a
bit of
drill.
a
Yeah,
ping on the internet line, or was it just real natural organic stupidity?
yeah, it's difficult to say, but I still think that yeah, this yeah, whatever happens, I think gold looks like it could break out soon because we've been consolidating for 4 months, and I think it's looking a lot better. What about you, Clive?
Well, it's got this nice flag pattern where you have the flagpole going up and then it trades sideways with ever smaller ups and downs until it gets to the point at the end of the triangular flag. So if you can imagine a football flag, it's pointing to the right, and you've got the flagpole up, which is what happened to gold, and then it starts to go backwards and forwards in a zigzag pattern. But each zigzag is slightly smaller than the last one. What you're waiting for is a breakout in one direction or the other. Now, more often than not, when that happens, it's a breakout to the upside. But the thing to watch is when it does break out, that's when the big move is coming in the direction that it does break out. So I'm hoping for everybody who's listening here that it will break out to the upside, and that's where the probability lies. It's more likely to do that than go down. But of course, you never have any certainty in life with these things. But it looks positive to me, and I think with everything we're hearing about what's going on in the world, I'll give you a small example. I've just done an exercise which I published on LinkedIn today about the interest on the national debt as a percentage of their tax take. 3 years ago, the interest cost to the government was about 10% of what they collected in taxes. This year, according to my calculations, and it's pretty close to this Congressional Budget Office's calculation, but I'm slightly worse. They say 18.5%. My calculation is that the interest on the national debt this year, 2025, will be just over 20% of what they collect in taxes. So basically, it's doubled from 10% of what they collect in taxes to 20% in just 3 years. And that direction of travel is going to carry on. So on that metric alone, things are starting to spiral out of control unless something very dramatic happens. Either there's a lot more taxes collected, or there's a lot less expenditure, or they revalue gold at a sufficiently high level to get rid of that huge deficit which is running up, or they think of some other miracle plan to resolve the debt situation. And I don't know. I mean, there are other things out there. Maybe they can get the banks to do a bail-in or force them to buy more treasuries. But things are getting into dangerous territory. Yeah, one thing which might solve this would be a massive reduction in the yields on 5 and 10 and 20 and 30-year treasuries. If those yields were to come down, and don't forget those yields are not within the control of the Federal Reserve, but if those yields were to come down, that might help things. But at the moment, the Congressional Budget Office is forecasting an interest rate of about 3.1% for 2025. I think it's going to be a little bit higher than that. And I think that next year it's going to be higher still, and the year after higher still, all because they got this huge quantity of debt maturing at 1 to 2%, which will have to be refreshed. And even today, you buy a 10-year, 4.2%. That's a lot higher than the 1 to 2% yield, or not yield, interest rate, which is being paid on the debt they took out over the last decade. So I think we could have a credit crunch at short order. And I'm not saying next week or next month, but at some point, people are going to say, we're not taking any more government debt because the interest cost is just getting too high as a percentage of everything.
Uh, Francis, what do you think of this chart? I heard you talking in your video with your scooter that you think we could consolidate a bit longer. I actually thought that here a few weeks ago we were breaking out, but then it came back down. And now it looks like this week here we're going to maybe open right near this line, and there's going to be a little bit, maybe it will try to break out again.
I'll give you a technical assessment if I can share a chart, if that's all right.
Yeah, let me just make it, let me just allow you to share. Okay, go ahead.
I'm a little bit, it's rare that I don't have a dominant opinion. I'm going to show you something, first of all, which is the monthly chart. And I
Yeah.
just want to pull this through and magnify the bit I want to show you. Sometimes when I'm trying to get clarity on direction, because we have a direction-based issue here, it's
Mm,
sometimes just best to look at the really big time frames. We've had
yeah.
an unbelievable run. If I just switch my lines on, we predicted the 293,000 range. And then, as I mentioned, we had a super surge with Trump tariff tantrums that actually ran us up to 3.5.
Yeah.
And when you look at it on a weekly chart, that's that blow off pole that Clive was referring to. Now, the interesting observation on a monthly basis that I will make is that we're still very early in the month, and that means we're 10 days in, and I would say you're barely a third in. And what I will point out that is slightly more circumspect than no one's been more bullish during the 2011 break than I was. We've now done a lot. And I'm also concerned generally about the August, September, October, November period. The October particularly, if there's any contagion, it tends to follow afterwards. And I want to highlight something here. If you take the pink crayon with me, we got knocked back from 3.5 quite a long way. That's a rejection. This is what's called a rickshaw boy. It's like a man on a bicycle from above. That has 50% of it is again a rejection. This normally, if it was at a localized high, would be called a shooting star. Again, you're at the low end of the candle and you got rejected a lot. And if I delete those three, the last month, we attempted a breakout again and were rejected again. And we're currently we are incomplete, unformed candle for the month. And we seem to be having the habit of the early part of the month we're testing, and the latter part of the month, the last week, we're being brought back down. So observationally, that's been a cycle. Now that might have something, obviously quarter ends, you'll expect the triple witching of futures, etc., etc. There might be some manipulation in there because one thing when you go really high, this is just again an out there thought, unfiltered. We had extremely high platinum lease rates and also high silver lease rates. And previously, the thinking has been they've kept precious metals as a category generally down by bullying the little guy, silver. What I wonder is happening right now is that the lease rates and the availability of both silver and platinum have become so chronic that they now almost have to regulate or fight to a degree, the degree that gold goes up. Bear in mind, this move has been violent. You know, this is a huge move. This was our 2011. You should be, if you're ever going to be leveraged, this is a leverage long moment. You had 2 negative months before running 3,500 from our call at 2011. You had the better part of about 20 months up, 18, call me a liar, or a couple of months either way. So I'm watching this block and I'm going to mark it out on this time frame. And I want to see that we actually survive past a month end. It does feel to me that 3.4, 3.5 sees rejection because the 3.5 is the next halfway. You're closer to 4 than you are to 3 when you're 3.501. And it does seem so far that we've had the last weeks. So if we drop it to the weekly, you'll start to see that this is typically coming weekend. So I wanted to highlight that to you. And if this traded down, which it's got 20 days to do, and it just frustrates everybody a little bit longer, especially after all this hype and talk, it's actually not when all the hype and talk is around that you get your home run. It's actually often a fake out for retail. So I'm a little more circumspect here than I was down here. I was leverage long, investment long, and loved it, and said you don't own enough and you aren't long enough, with short stops here going long. Right here, I'd like to see how the month closes, which is still 20 days away, before I would get exuberant. If I drop the time frame, just to answer fully the technical question, there is some positives on the shorter time frame. So this is weekly that I would take out. We have a very specific candlestick pattern that we watch as a community and HVF method traders, and we call it kettle drumsticks. It's actually a combination of two candles, and it occurs, and they look like what's typically referred to as a shooting star and a hammer, but they don't happen at chronic localized highs or chronic lows. Normally a hammer would be like this after a long bear market, and you would call the reversal to trade up, and the shooting star is the corollary, something like that after a long bull market of green candles, and then you'd get a line of red, and the tactical trade is short there. You could start with a stop loss there and trade. When you get them in a squeezing, a volatility, so we're specialists in volatility squeeze. This is what we do. And we feel that is a bit like when you're walking in a tunnel and you're trying to test how high the concrete is so you don't bash your heads, and where the floor is. It's dark. This is range definition rather than localized high and localized low. And range definition comes when you're squeezing before a break, and the current candle is moving without being too exuberant towards the high side, and I would treat that level being broken as possibly the move to the upside. So whilst monthly view is, it would be good to know, you'll be late if you wait for the full month. So I would probably definitely be leveraged long on the break of that, and I would be expecting 3,820 going for 3,9 if that happens. If we stay within the two candles range, I would be concerned if it doesn't come in the first 3 weeks of the month, that the possibility of the monthly view and that sell-off into range. So I'm giving you a fork, an if, but, and maybe answer, but it's quite holistic, and I actually think it's far more useful than it sounds, because everybody is just binary, like a light switch, bull or bear. What are you, bull or bear? Bull or bear? Macro, we always bull. Weekly, I feel the break of this technical high here. I'll give you the number of it, by the way, so that everyone can hold me to that. 3,439. Trade 3,440 on the Oanda broker. That might be small variances. And I think you're probably in a breakout mode. Run this low here, and we could just consolidate a while longer. And maybe if they did a demand destroying event and they wanted to get some debt out, they could get a bit more the rates. Because the one thing when you look at gold, I don't look at it in isolation. We should also be looking at the US 10-year and various debt instruments. What's actually happened is they've got a little bit softer on the yields. We're getting a little bit of an upbid after that gold excitement now, but we were selling off from here. So how much lower can we go? Is this going to break to the upside and hold? Or could we actually, have a down move? So there might, if bonds coming down, you want to watch that as well. You want to watch the yen. So we watch a lot of things. I've given you my best for a quick 3-minute answer.
Yeah.
To answer it properly, I'd probably end up, talking for 20 minutes. So that's not what's required. But you would look at other things like the Japanese yen and other debt markets just to see the general feel.
All right. So,
And the Dixie.
yeah. So do you want to, stop the
I'll stop the
sharing?
share.
Yeah. And because we've gone over our usual time, so I wanted to thank Clive and you, Francis, for coming on, and like to thank all the viewers as well. And like Francis said, macro long term, you need to keep stacking and holding to your gold and silver. This is more like for trading. It might help you with your miners as well. You because if gold's doing well, the miners are going to continue to do well. And we didn't even touch upon the fact that miners are still very much undervalued, I would say, versus gold. So I think there's a lot of opportunity there too. So, Clive, any final words? And then Francis?
Well, I would certainly agree on the miners. I mean, we've had a very good run this year, extremely good run, but it's been the first year for many, many years that miners have been outperforming the gold price. But I think this is most likely just the beginning. I've done my own maths on lots of gold miners, and in many cases, based on a gold price above $3,000 and not as high as we are at the moment, I reached the conclusion that next year the price earnings ratio will be around, well, it'll be below 10, a low price earnings ratio with a lot of growth. And I think that's when the algorithms will kick in lots of computers and things, and people, they want to buy growth at a reasonable price earnings ratio. So I think that, should be self-fulfilling in terms of price. It should be pushing the price of gold miners somewhat higher, because I don't think next year they'll be trading on price earnings ratios of 7 or 8. I think they'll be perhaps 12 or 13 or 15, which is where they are now. But those ratios are going to come down, as I said, because of the fact they're starting to sell the gold at these higher prices than last year.
Yeah, Francis, any final words for the viewers before
We're going to be doing a big deep dive on the miners. We see immense value there. There's one key point that just makes me a tiny bit scared, and that's the great taking. You've got to have certificates. You've got to be able to broke and get your certificates. And then it again, like what Clive was saying, is approach to gold. You should hold on to the certificates for quite a sustained period, and we have quite a few that are macro doing really well. Just to pull up the chart one more time quickly, because you asked for mines. Here's, for example, Fresnillo, the falling wedge. This is a huge chart. This is a quarterly chart.
Yeah, I
That's
noticed this company last week. I got
UK
notices.
based. You should.
Yeah, it was. I got notices from my broker. It was going up 5% every day.
They're
Yeah,
silver miner, aren't they?
yeah.
And a very big and a very high quality one, with excellent holdings. We've also in Agnico Eagle. And I mean, this has a similar structure setup that we love. These are the HVF volatility constructions, pattern setups. This is in a break, massive target. You want to find out where we think it's going to end. You can jump on the Market Sniper YouTube channel, or come and book a call with us and find out more. But this is going to do famously. We have other miners, and we're going to be further bringing to mining the list, if I can say that. And we're going to be getting a guest on who's a specialist in rating gold and silver miners as well, that we'll be talking to both in our community and probably on the YouTube. So I 100% concur with the miners. My only caveat is your broker must be able to provide you the certificates. And because paper certificates have to get posted and put away, this should not be something that you're buying on Monday and then deciding by Wednesday you're not so sure anymore. This is big macro trading, and I think the multiples will be absolutely vast. And I think they're turning into cash hemorrhaging cows. And it wasn't much longer than 6 months ago, and most of the accountants that were valuing miners still had 1,800 gold and 2,000 gold valuations. And we've got to point out that not only has the price gone up, the better part of 70% plus, it's more likely to go higher than to retrace through where those accountants are. And at the same time, the ones that have survived the dry period are pretty lean ships. So there's not a lot of fat on these businesses. They're going to be cash cows. And the dividends, I would suggest you want to reinvest as well. And these should be typically 5 and maybe even for full cycle 10-year holds, because I'm seeing hyper-stagflation, sustained element of everyday item commodities going up. That is how they will debase the fiat. And that's how you'll notice the debasement of the fiat and the debt that they absolutely need to do, and the ongoing issuance that they absolutely need to do. And rates are going to go a lot higher. People who are leveraged need to watch out on property, credit cards, or anything else. So those are my cautionary tones. Real opportunities, though, commodity and resources bull, but the reserve asset of precious metals is first and king. in this move. So be part of that, and miners are going to start to get a major re-rating. And I agree with you.
Great. Thank you, guys, and thank you for the viewers as well. And I wish you all a great rest of the weekend or beginning of the week. You could be in Australia or New Zealand. Take care, guys. Thank you.
Yes, bye-bye.
Bye.
Bye-bye. I don't know what I'm doing. Sorry, I'm trying to stop the
That's
share.
all right.
It keeps changing screens.
I've ended this
Help,
screen.
help.